Lock-in rate is equal to, anyone knows the formula? Opening future.
The futures rate plus the basis, unexpired basis.
No, the formula which I have told in the practice classes. Use this formula always. Okay. Opening future rate. Opening future rate minus opening future minus current spot into remaining months divided by the total months. Let me explain now. Let me explain everything. Okay. Always write the date. Date लिख लिया करें. Always write the date. For example, today is 1st January, and you have selected June future. June future. And transaction date is 31st May. So today's date is 1st January. Future is of 30th June. So total months are 6. Now just check. When you are going to buy, when you are going to end this contract on 31st May, but the future is of 30th June, you are going to close your transaction on 31st May. So how many months are remaining? One. How many months are remaining? One. 1 month is remaining. Okay. Always write the date. Current spot means current date. Opening future rate is, select the opening future date. If it is September, if it is September, 30th September. If it is August, 31st August. If it is June, 30th June. So it's June, for example, 1st January. And if it is June, 30th June. So how many months are total? 6. And when you are closing your transaction, for example, 31st May, 1 month earlier. Remaining months is 1. When you are closing your transaction 1st May, that means 2 months are remaining. Write the current spot date. Okay. Current spot date means today's date. आज का दिन. Today's date. That is 1st January. Then write the future rate. So if you have selected June contract, that will be 30th June. If you have selected March contract, that will be 31st March. If you have selected September contract, that will be 30th September. If you selected December contract, that will be 31st December. So that these are 3 months. Total months are 3. Now check. When you are actually receiving the currency or paying the currency. On 31st March, months are 0. On 1st March, 1 month is remaining. On 1st February, 2 months are remaining. So remaining months either will be 1 or 2, not more than that. Okay, remaining months will be either 1 or 2. That's it. Simple, use this formula, it will automatically cover the trend. Simple, use this formula. It will auto cover the trend. Okay? There is no need of remembering the trend. It will auto cover. There was another question from the future, from the options. I had a doubt in 7th step of the option. When we exercise the call option, we would be paying the exchange as we are buying, right? So it is a payment. And so say we exercise the put option, we are exercising right to sell. So it is a receipt due to from exchange. So let me explain the 7th step for you. For example, I'm making a case. Home currency is pound and it's a dollar receipt case. You will be selling dollars, right? Okay. Contract size is given. 62,500 pound. So please tell me, guys, if there is an export of $1 million, contract size is given in pound. So it's a call option or put option? Pound call option or put option? Please tell me, everyone. Pound call option or put option? So we will be selling dollars and buying call. Buy pound. Okay, remember this. So we will solve one step, second step, third step, fourth step, last step. So let me arrive at last step. So what you will do in last step? It is assumed that option will be excised. Okay. So what is the option? What is the option? Can it is written on the screen? Please tell me what is the option. Anyone? To buy the pound. So it will be a case of receipt, right? So formula will be number of options. Okay. For example, number of options are 100. For example, number of options are 100 into contract size. So it will be 62500. Just don't confuse with this. In 7th step, always there is a need to calculate answer in home currency. In 7th step, we will always calculate answer in home currency. So we will buy the pounds. We will receive the pound. Call option means we will receive the pound. Okay, please tell me, in order to receive the pound, what you will deliver? What you will deliver? We will sell the dollars. So go in the working. We will sell the dollars. Payment. That payment should be in foreign currency. into strike rate. Okay. Now compare it. You're buying this, you have to pay this. Compare this with the foreign currency. Okay. Then compare it with foreign currency receipt. You will pay that. This will always be in foreign currency. You will pay this in the foreign currency. Okay. For example, it has arrived at 980,000. You are receiving 1 million from foreign supplier. So that means how much you are receiving extra? 20,000. Sell it. And for example, you are receiving 1 million, but here answer is 1020. So that means you need 20,000. Buy it from market. So I think the point which you need to remember here is always that in the last step, always write that option will be exercise, and then keep this into your mind that in last step answer should be in home currency. Answer should be in home currency, and foreign currency and working should be in foreign currency. This point you should remember. Okay, okay. Answer should be in home currency and working should be in foreign currency. You need to remember this. So here home currency is pound in my example. So what you will do? Number of options into contract size. Answer is here. You will receive this from exchange. It's a receipt. So why sir it's a receipt? Because it's a call option. Otherwise it would be a payment. So if you are receiving this, you have to pay this to the foreign currency. Take the same amount into strike rate. Okay, there can be a question. Some student may ask, sir, sometimes examiner use strike rate here. Sometimes examiner use strike rate here. So when we do strike rate, where we have to multiply the strike rate, simply remember, in 7th step, answer should be in home currency. If you have a number of option, 10 for example, contract size is in the same currency, in home currency. So there is no need to multiply with the strike rate here. You will multiply strike rate here. And sometime home currency, sometime when you multiply number of option and contract size, answer will not arrive at home currency. You have to multiply strike rate here. Okay, are you getting this point? Yes? Are you getting this point, right? So one thing which you need to remember systematically, in 7th step, answer should be in home currency and working should be in foreign currency. If you multiply number of option and contract size, if you arrive at the home currency answer, then multiply here with the strike rate, answer will be in foreign currency. So for example, you have to pay 1,030,000. But your actual receipts are 1 million. So guys, you have to pay 1030, but you have only 1,000, 1 million. So what you will do? You will buy this 30,000 from market. Buy from market. Buy at the forward rate. Normally, buy from market means buy at the forward rate. Okay, okay. And if your payment is less than 1 million, you will sell to the market because you are getting extra. Okay, you got it. Any question on the call option? Okay. Now, if it is a put option, obviously that will be a case of import here. Don't memorize it. Every question can be different. So if there is a dollar import contract size in pound, it's a pound put option. So what you will do? You need to calculate the answer in home currency. Number of option, contract size, answer in home currency. Okay, if you are paying here, so that means here you are receiving. What you will do with the receipt? You will pay to the foreign supplier. Foreign supplier. So if you are receiving 1030 and you have to pay 1 million to the foreign supplier, so that means you have a extra 30,000. Sell this to the market. Think in this way. One key point which you need to remember in seventh step, answer should be in home currency and working should always be in foreign currency. So life would be much easier if you follow these. Okay. Right. Now, one more thing. If you do not exercise the option, then what will happen? If you do not exercise the option, if there is a case that if you do not exercise the option, what will happen? If you do not exercise the option, examiner will give you the spot rate. That what rate is going to be happen in the market. So if you do not exercise, you have to buy or sell at the spot rate. Okay. If you're not exercising it, you have to buy or sell from the market. But remember, you have to pay the premium at any cost. That spot rate should be enough. That spot rate should be enough that it would be you would be indifferent by comparing it with the excise price. By comparing it with the excise price. So there was a question in past paper. In that case, it was a question that what would be the spot rate, that how spot rate would move if you would become indifferent by if you would become indifferent whether you do the option or whether you do the spot market. Spot market should move enough that it would be indifferent for you that whether you do the transaction on the spot or whether you do the transaction on exercising the option. तो वो जो स्पॉट रेट है वो इतना मूव करे, स्पॉट रेट शुड मूव इनफ दैट इट शुड consider the option premium as well. So one case, compare excise price to spot price. But hardly you can find any question where closing spot is given. Obviously, if there is a benefit of converting at excise price, you will do the excise price. If there is a benefit of converting at spot price, you will do the spot. But if you have to compare completely the option case and the spot case, then spot should be moved enough that it should also consider the premium impact. For example, I'm just telling a very simple case. For example, option is at 80 Indian rupee over dollar. It's a case of receipt, 1 million receipt. So if you convert at the option rate, you will get 80 million INR. So if there is a case of spot, and for example, there's a 2 million INR premium as well. So net case will be net you will get 78 million INR, Indian rupee. So spot rate, you do not have to wait spot rate to move 80. If spot rate moves to 79, so you have a very win-win situation in spot case. Multiply 79 with the 1 million, you will get 79 million. So if you have to compare a completely different case, that we should do the option or we should move to the spot market. So in order to compare the spot market with the option, you also have to consider the premium as well. Okay. बात समझ आई guys? Did you get it? Okay, in option we have to pay the premium. You know that. So if you are comparing with the spot market, then spot market should move enough that you will be comparing it with the premium as well. So let me open the assignment question. वो भी देख लेते हैं. Okay, here I'm assuming that in spot case you didn't enter into option at all. You didn't enter into option at all. Then anything above 78 is okay. But if you are comparing this case, option case, okay, exercise price is 80 INR and at maturity, you have to decide whether to exercise or not. Then compare closing spot. So this case is different. Here at maturity, you only have to compare the exercise price with the closing spot. So why not premium? Because you have already paid the premium. That is sunk cost now. So let's suppose closing spot is like 81 and it's a proceed case. So you will not excise. You will sell at 81 rupees at market. $81 million. But you still have to pay the option premium. Okay. What was the above case, sir? In above case, I'm comparing the option with the completely independent case that if I would not have entered into a option, what happened in the spot? ठीक है, okay. Okay, this is the question. So let me quickly solve its both cases. Today is 1st March. Payment of 18.25 million euro. Okay. Let's solve the lock-in rate. I'm assuming you will solve the remaining steps. What is the opening future? 1.156. Minus dollar over euro, no? Minus the current spot. Payment, hai na? So it should be with spot. Multiply, hai na? So 1.1497. फाइव वाला लेंगे 1.1497. So what is the today's date? 1st March. Which future you have selected? September. And payment is on 1st August. How many months? March, April, May, June, July, August, September. 7 months. When you are closing the transaction on 1st August. So how many months are remaining? 2. So please calculate the lock-in rate. Guys, please calculate the lock-in rate.
1.1542.
So 1.154. बस आपको ये फॉर्मूला नहीं पसंद आया? तो आप अपने वाले फॉर्मूले से कर लो. Answer would be same. नहीं? क्या आपका आंसर? What is your answer? Okay, the good thing about this formula is you do not need to remember what is the trend. So it will work everywhere. Okay. Now let's quickly do the options. Let me quickly solve the option. Okay. We have to pay, we have to buy euros and contract as in euros. We have to pay, so that means it's a call option. Someone please tell me number of contracts, guys.
146.
146. 146. Okay, perfect. And it's a, okay, premium is, you will take the premium of 0.69, excise price is 1.140. Okay, let me quickly move to the last step. You will assume that option will be excise. Okay. See? So now, quickly write. Answer should be in home currency. What is the home currency? Dollar. Answer should be in dollars. Okay. I'm just showing the working here. And working should be in euros. So for number of contracts, 146. It's not the case of receipt, payment. Payment is the case. Because of case of payment, 146. What is the contract size? Right? 125,000, na? 125. Okay. If you multiply these two, can we get the answer in foreign currency? Can we get the answer in home currency? Please tell me, everyone. No. So multiply with the strike price. That is 1.1540 dollar over euro. So what is the answer, guys? Multiply, please multiply, everyone. What is the answer? Multiply है मुश्किल काम दे दिया मैंने 21,060,500. Right? Okay. Okay. If this is a payment, here we will receive receipt from exchange. Right? Receipt from exchange. 146 into 125,000. So how much euro we will receive? Okay. And how much actually we have to pay? What is the payment? 18,250. Acha. So is there any overhedging, underhedging? Is there any buy or sell? Is there anything we need to buy or sell? No. There is nothing. Just assume. Just assume. Just assume. It is 18,300. So we will receive 18.25. We have to pay 18.3. So we need to buy 50,000 at forward rate. So we will buy at this forward rate. And for example, if it is 200 or let's say 180, so we are receiving 18.24, but we have to deliver 18.18. So 70,000 we have to sell in the market. Sell and market. That you will do. But the main point, key point to remember, key point which you need to remember. Here answer should be in home currency. In working, answer should be in foreign currency. You will never do the mistake, to be honest. Buy, we will buy at a rate at which we have to pay more. Na? If you're dividing, divide with lower. If you're multiplied, multiply with higher. Now apply this principle on every question. Okay. If we are selling the excess, we will divide at the higher rate or multiply with the lower rate. Simple. Selling means divide at higher rate. Buying means divide at lower rate. Simple.
Sir,
Yes, yes.
I have seen question at times. It's depend if you have to convert in the home currency. So if we have to convert in the home currency, so we have to use the lock-in rate here. We have to use the lock-in rate, but Here we multiply by the locking rate. Is there any case that we divide by the locking rate, or it's always we multiply by the locking
It
rate?
depends. It depends. There is no need to memorize it. It depends. For example, in this case, how would I know that I should multiply? To be honest, I have.
Yes.
Do not apply
How can
anything
you?
here. Do not write anything here. Simply write exchange rate 1.154. What is it? Dollar over euro, right? Dollar over euro. Okay, euro in the numerator, euro in the denominator, we would multiply. If it is euro over dollar, so euro in the numerator, we would divide simply. Do not confuse yourself. Do not memorize by heart. It's simply apply the logic. Okay. Otherwise, if you forget an exam, what will happen? Problem, no? Now let's take any random question. Let me open the. We will discuss your assignments later on. Let me open any random question. Let me open the question bank. Okay, these are risk question. Take the name of any question. Let's do randomly. The last step. Let's do the last step randomly. Any question. From 57 to 80. 24 questions are remaining. Daikon is interested and Daikon is of interested. CMC. So let me. Where is CMC? 63, page number 101. So one of the student has now said, I know I'm not solving the complete question. Bhai. I'm not solving the complete question. I'm just solving the last step. CMC इसी गई. I will also tell you about the Lignum company. Don't worry. Okay, this is a CMC. Okay, what is the case? A payment of 5.06 million, which is due in 4 months' time. You are a Swiss company. Home currency Swiss franc. Payment $5.06 million. Okay, option is 125,000. Contract size 125,000. Please tell me it's a call option, put option, which option? Dollar by CHF sell. Right? Okay. Correct. Last step. Answer should be in which currency? Which is the home currency? CHF. Working should be in dollar. So number of options, if anyone remembers. Can someone please open the answer and tell me what are the number of options? Or let's calculate. Let's calculate. 38, okay, 38 into excise into 125,000 CHF. So should we multiply with strike price? Please tell me. No. So multiply these two. Right? Okay. Okay. This is the case of home currency, CHF put option of payment. Here we will receive 4750, or you can completely write it. 38 into 125,000 CHF. But we need answer in dollars. So we need to multiply or divide with excise price. There are two excise price. Let me solve with one of them. Let's suppose 1.06. Let's suppose 1.06. Okay. So what so what is 1.06? This is dollar over CHF. 1.06. So multiply or divide? Multiply. What is the amount? 5035,000. But how much we actually pay? 5060,000. Are we don't we short of money? We are short of money, right? Buy from buy at forward rate. That's what you have to do in the last step. Okay. And let's suppose if the excise price is 1.07. What about in that case? 5082. So in that case, we are excess of money. In that case, we will sell. We are excess of money in this case. So I will solve A and B part and discuss the remaining parts. Okay. Now the question is, okay, F company is an American company with a centralized treasury function based in US. However, if company board is currently considering whether to establish additional treasury function in some or all of the other countries in which F company operates. So technically there is a theory question. You have to discuss about the centralization and decentralization. It's a very famous topic. Examiner favorite topic. Examiner test it again and again. Today's date is 1st March. Company treasury team is currently looking at the hedging payment of 18.25 billion to a German supplier, which is going to due on 1st August. Spot rate is given. Spot rate September future is given. Option is given. Treasury team has also been asked to consider two scenarios for which the exchange rates could be on 1st August. Also the significance of basis risk. So exchange rates are given on 1st August. 5-month forward is given. Currency future price is given. Then there is another scenario is given. So recommend on financial ground hedging strategy for 18.25 million payment using the market data available on 1st March. Exhibit 1 and assuming the options are exercised, assuming basis diminished to 0 at contract maturity at a constant rate based on monthly interval. Then in B part, you have to discuss the scenario 1 and 2. So first of all, quickly solve the above part. So part one, we solve here. Part one, and there are 2 to 3 options: forward and future and options. Number one step. Let's do the forward contract. So before the forward contract, so payment in dollars, 18.25 million. Sorry, payment in euros, na? 18 point 18250 triple D. So forward rate. Forward rate is given 1.544 because we have to multiply payment and then multiply. Have to quickly solve it. 1.544 dollar over euro. 1.544 days of payment. Okay. 28.178 million. 1.1544. 1.154. Second case. Future. First step. We need to buy or sell the future. So contract currency is 125,000 euro. So if contract currency is same, that means we will buy future. Okay. Settlement date is September. Okay. Number of contracts. 125,000. 146 exact. Okay. And expected payment you have already written. So let's calculate the lock-in rate. We have already done that. You can also write a few points here so that you can easily calculate it. Opening future rate, dollar over euro. Current spot rate, dollar over euro. So what is the opening future rate? 1.1560 and spot is 1.1497. 1.1560, 1.1497. Lock-in rate. Opening future minus bracket start opening future minus current spot into how many total months? Today is 1st March. Contract is of 30th September. 7. And you are closing the contract on 1st August. 2 into 2 over 7. 1.1542. So you can write expected payment. Expected. Yes, one. Okay. Expected payment in dollars. So I'm just let me solve option contract here. First is expected payment. So if it's a buy future, it will be a euro call option because contract size is in euros. Okay. Settlement date is September. Payment divided by 125,000. Same. 146. Exercise price is 1.1540. Okay. Premium. Call option. It's call option, no? 0.69. 0.69 divided by 100. Because 0.69 is in cents. So you can calculate the premium as well. Premium cost dollar over euro, number of contract 146 into 125,000 euros. So euro will be cancelled out. This is in dollars, right? Please check. This is in dollars, right? You can write here even. Contract size. Okay. Now let's assume it is assumed that option will be exercised. Answer should be in dollar. Working answer should be in foreign currency. Okay, euro call option, you will receive euro and you will sell the dollars. Payment in dollars. Foreign currency. How many contracts? 146 out. 146 contracts. Into 125,000. Into this. So you will pay 21.06 million payment and receipt in foreign currency. Number of contract 146 into 125,000. So how much you actually pay? Payment to supplier. It is exactly same. By the way, in this question, there is no need to do this because we know there is an exact hedging. We will not get any marks on this. I'm just doing for you people. Okay. Then premium. Total payment. Okay. So there are no marks for this because there is no Under hedging, over hedging. Okay, now let's do the B part, scenario 1. Let's read the scenario 1. The treasury team has also been asked to consider two scenarios for what the exchange rate could be on 1st August. Significance of basis risk. 1st August, this would be the spot. This would be the option. Just to look at the data. This is a scenario 1. I will delete this later on. Okay. We have done 3 contracts. Please tell me, in future, if there is any change in the market, will there be any change on the forward contract?
No.
Forward contract answer will be same. Forward contract answer will not change. Whether the exchange rate moves upward, downward, whatever happens. Forward contract. Forward contract answer will not change. Plus, this 5-month forward contract is not the previous one. This is a new forward contract. Plus, this 5-month forward contract in scenario 1 is different. This is if we entered now for next 5 months. Okay. So this is not the same forward contract. This is like if we enter now, what will be the forward contract? What was the opening future? 1.1560 on 1st March. What is the same future rate on 1st August? 1.1552. 1.1552. Guys, ignore this. Ignore the above. Ignore the above, please. Look at this. What is the future, opening future on 1st March? 1.1560. What is the future, the same future rate on 1st August? 1.1552. Let's assume, ignore the lock-in rate. Let's assume if we have taken the position that we will take the position on 1.1560. Now the same future move to 1.1542. So what is the gain loss? Let's calculate that. Ignore the previous one. So by the way, we have already taken the position by technically it's a gain or loss. Guys, technically it's a gain or loss. Loss. How much? 0.008, right? Okay, we will face this loss. Plus, we also have to face the spot rate. Remember, we have to buy this currency from the market as well. Na? And what is the market rate? 1.1534, right? So together, how much we have to face? $1.1542. So that means this is our effective rate. Now let's compare it with the effective rate, with our lock-in rate. Is it same or not? Let's compare it with our effective rate. Is it same or not?
Same.
Is it same? Exactly same. So that means our cost will not change. Our result will not change. So now compare, this was scenario number 1. Let's quickly solve the scenario number 2. What was our original position? 1.1560 by in 1st March. So let's suppose on 1st August, what will happen? Look at the scenario number 2. What is the future rate? 1.1563. $1.1563. So is it a gain or loss? Gain 0.0003. And spot rate is spot rate is 1.15. In scenario number 2, what is the spot rate? 1.1549. Higher, na? 1.1549. 1.1549. So this will be deducted. So now compare it. This is our effective rate. Now compare it with lock-in rate. Is it same? Is it same? No. In first scenario, was it same? In first scenario, was it same? Yes. So we can say that in first scenario, remember, in lectures, we have covered the basis risk. What is basis risk? Basis is the difference between current spot and the future rate. Basis is the difference between current spot and future rate. And what is basis risk? That this spot will not move eventually and will become equal to future rate. It is our assumption that current spot will gradually and slowly move, evenly move, and will become equal to the future rate. But what is the basis risk? That this will not become equal to the future rate. So in scenario number 2, companies facing the basis risk, the actual effective rate is not equal to the lock-in rate in scenario number 2. But in scenario number 1, company is not facing the basis risk because the effective rate and the lock-in rate both are same in the first scenario. Okay, that was the main discussion. Okay. Please ignore the previous discussion.
Sir,
Yes.
if you are to write a few lines on basis with about the formula that we have, what can we write else?
Okay. First of all, I will write that basis is the difference between current spot rate and the opening future rate. right? Then you will write, it is assumed that the difference between current spot and future rate will diminish, will decrease over the period of time, and at maturity, current spot will become equal to the opening future rate. Okay, that was basis. What is basis risk? Basis risk is current spot and future rate difference will not diminish to zero, will not end. The difference between these two will not end. At maturity, both will not become equal. So what happened here? At maturity, our effective rate and lock-in rate both are not equal because the spot rate does not move in a direction of the future rate. Okay. That's the point which you will write. Okay. So you will write here and spot rate, the loss. Okay, this is not the buy future on 1st March, 1st August, that is sell future dollar over euro 1.1552 loss okay spot is dollar over euro 1.1534 effective rate. Scenario number 2. Okay, lock-in rate is dollar over euro 1.1542 and scenario 1, there is no basis risk as effective rate as spot rate moved in a direction moved in relation to future rate and effective rate and lock-in rate both are same. Okay, here effective rate is not equal to this. Okay, 1.15 1.15, what was the case here? 1.1563. Okay, 1.1549. In this scenario, both effective rates are not same. So what can be the reason? Only one reason. Because of basis risk. Spot rate didn't move in direction of future rate. Okay. We cannot reduce or manage basis risk. We have to face this. This is the inherent part of the inherent part of the option contract. Sorry, future contract. So let's option contract. So in option contract, you will compare the exercise price with the spot price. So what is the exercise price, guys, which we have originally booked? Exercise price 1.1540. Okay, please tell me in scenario number 1, what is the spot? 1.1534. 1.1534. So please tell me, will you buy the euros at 1.1540 or 1.1534? Please tell me, everyone. Will you buy the euros 18.25 million euro at 1.1540 or at 1.1534 at market rate, or we will exercise the option or we will not exercise the option? If you are confused, use the calculator and multiply with both. Option will not be exercised. Come on, Zaki, you can't buy at 1.1540, na? It will become expensive. It will be very expensive. Option will not be exercised.
अच्छा एक बात तो ये है कि अब जिम नहीं जा होगा मेरे से आज
क्यों?
कल जाऊंगी क्योंकि बच्चों को भी पढ़ाई बहुत रहती है
Guys, give me a minute, please. Okay, one thing to be noted. Even if we are buying at the spot rate, we still have to pay the premium. So add the premium here. So total cost is 21.175 million. Okay. So what about in the second case? What about the second case, second scenario? In second scenario, exchange rate is 1.1549. So now please tell me, will you exercise the option or buy from the market? In second scenario, will you buy from the market or excise? Excise. So option will be excise. We will not do anything because we have already done that. Okay. So we will take the original position. Okay. Please ask question now if there is any question from these two scenarios. Because the question was, okay, you have taken position on 1st March. What you will do on 1st August? In forward, you will do nothing. In option, you have to compare with the spot and decide whether to exercise or not. In future, although you will not do anything, but your final position will be different in future if the effective rate is different. Sir, how the effective rate will be different if the basis risk is different? Okay, okay. Guys, is it okay? Okay, one other way of looking at it. Just look at this. 1st March. Please look at the data and tell me what is the current spot and what is the opening future rate on 1st March. Please tell me what is the current spot, guys? 1.1497. What is the opening future rate? 1.1560. Everyone?
Yes.
Okay. Please tell me. What is the difference between these two? 0.63? 0.0063? Right? Everyone? Right? When we are closing our position on 1st August. So according to the 1st March, what are the remaining basis points? What are the remaining basis points?
18.
18. Everybody is okay with this? We have incorporated this and calculated the lock-in rate, right? No issue, right? No. Options are not on the future. That is in the interest rate risk management. Here in currency, option is on the spot. So that's why you will always compare exercise price with the spot, not with the future. That will happen in interest rate, not here. Okay, now let me to tell you scenario number 1 and scenario number 2. Okay, please everyone look at the question and tell me what is the spot rate in scenario number 1. By the way, now date has changed. 1st August. 30th September. What is the spot rate on 1st August? Please. Yes. What is the spot rate on 1st August? Scenario number 1. Please look at the question. Scenario number 1.
1.1534.
34. And what is the future rate given in scenario number 1? What is the future rate given in scenario number 1?
1.1552.
52. How many months are remaining now?
2.
So what is the remaining basis?
18. Yeah.
So that means in scenario number 1, bases are exactly moving, which we have predicted earlier. Right? Okay. And in scenario number 2, what is the spot rate? 1.1549. And what is the opening future in scenario number?
1.1563.
So now, what is the basis? 14, right? So we have predicted then on 1st August, there would be basis point remaining. That would be 18. Okay. We have already done our prediction that on 1st August, there will be 18 basis point remaining. But in scenario number 2, how many basis points are remaining? 14. So do you think in scenario number 2, there will be effective hedging? Please tell me. Do you think in scenario number 2, there will be effective hedging? No, na? By how many points we missed our effective hedging? Please tell me.
4 points.
4 points, 0.04. We have missed our effective hedging by 4 points. So in a simple explanation, you can explain it. Otherwise, you can also take the effect. Remember how many contracts? 146 contracts. What is the contract size? 125,000. And we have missed our calculation by 4 basis points. So 4 basis point is like 0.0004 dollar over euro. This is in euros. You can also understand in this. Okay. So remaining basis, we have predicted 18. In scenario number 1, 18. So in scenario number 2, scenario number 1, there is no impact on option on future. But in scenario number 2, remaining basis is 14. Actual remaining basis is 14. We have predicted 18. So that means we will not get effective hedging. We have missed our effective hedging by 4 basis points. Okay. Right. Got it? Everyone? Please, is there any question? Please tell me. You can simply explain that our effective hedging will be out by this 4 basis point. So the learning is at start, if you are thinking that remaining basis point are 18, that doesn't mean at maturity, it would be exactly equal to 18. In maturity, if the remaining basis point are exactly the same which you have predicted, that means there is no basis point. But at maturity, if the remaining basis point are different from your prediction, so that means you have to face the basis risk. We can also calculate the closing future and compare it with new opening position. But this is the simplest way of explanation. Simplest way. Calculate the original remaining basis and calculate the Remaining basis on first August and maturity. If both are same, there is no basis risk. If both are different, you are facing basis risk. Simple. Okay. Okay. Let me open your assignments if there is any. Did anyone submit? Okay, Outlook is not working. Next week. Next week. Interest rate risk management. Yeah, I received only one assignment. So you do not write the euro with the numbers. Write the euro separately so that you can use it down. Do comma separated. Write the rate separate, amount separate, and then calculate the answer. Okay, overall it is correct, but you can write more comments here. Okay. So guys, next week there will be a interest rate risk management. So do revise that. I will send you the assignment question. To be honest, I forgot to send the assignment question, and that's why I've sent it today. But in next week, I will send it like 2 to 3 days earlier, inshallah. And plus, there will be a test on foreign currency risk management part. Everybody has covered that, right? We have a test on foreign currency risk management or restructuring. Someone please look at the schedule and tell me. Test is on which part?
We had test on restructuring last 2 weeks ago, I think.
So today we have tomorrow we have a test on foreign currency risk, na? So I will upload the test by tomorrow morning. Please complete that test. And thank you so much for joining.
Thank you.
Take care, everyone. And do revise the trusted risk management. Take care, everyone. Thank you so much. Yes, I will upload.